Watching us here on Chartbusters, let's go across to JK Lakshmi Cement. Posted a disappointing quarter for the fourth quarter and the minimum sequential margin expansion on the back of higher transport costs as well. Let's welcome Sudhir Bidkar, who's the CFO of the company, to discuss these earnings. Thanks a lot, Mr. Bidkar, for joining in. Stock at the low point of trade. What we'd like to understand from you is the view on demand and costs itself going forward. What do you project in terms of volume growth for this year, and at what EBITDA per ton will you be making those volume sales?
Good morning. This year we expect our volume growth to be in double digit, high double digit, and we expect to be inching closer to about 1,000 rupees EBITDA per ton. We have been last year we have been able to clock close to about 700 rupees EBITDA per ton, and hopefully we should be able to bring that to close to about 1,000 rupees per ton on a double-digit volumetric growth in the year FY24.
Hi, Mr. Bidkar. Good morning. Nigel on this side. When you're talking about volume growth in high double-digit, you're referring to what? Cement sales of the standalone entity or cement and clinker sales of the standalone entity? Could you just specify what you're focusing on?
Yeah, because in the coming year, we are going to get the clinker production from the UCWL expansion. So that will flow into JK Lakshmi, and that will help us to boost the volume going forward in the current year. Their grinding unit is going to come a year later. So hopefully with whatever clinker they are able to produce, we should be able to grind more in JK Lakshmi and able to show that sort of a volumetric growth as far as JK Lakshmi is concerned.
So you said volumes will be high teens, right? High double digit. So more than 15 to around 20% is what we could work with.
Yeah, should be able to do.
And this is standalone JK Lakshmi cement volumes, not clinker included.
Yeah, JK Lakshmi standalone cement volume. You're right.
Got it. All right. We like to clear out everything because otherwise the street gets a little bit confused. But you have given us that picture. EBITDA per ton, you're talking about 1,000 rupees from your calculation of around 700 rupees. By quarter four this year, you think it's possible?
Yeah, and we should be able to reach that. There's a gap of 300 rupees, and we have worked out how we are going to achieve that. So basically, we should be able to get about 150 to 175 rupees through higher realization, and the balance through should come from the cost improvement, mostly coming from the logistic cost improvement. And we are also going to go big on the renewable power. We are already about 46% on renewable power, and hopefully in this year we should cross that 50%. We are putting up a 40 megawatt solar power in Durg plant and also another 7 megawatt in the Sirohi plant. So that should help us to improve further. Plus, we are also focusing on the increasing the TSR by using alternate fuel AFR, and that should also help us to bring down the fuel cost.
What exactly is TSR? And when you say you are expecting realization improvement of 170, 175 rupees, are you looking at some price hikes going forward? And is the industry good enough for you to actually pass on those price hikes?
We are not. That will be through our improvement in our geo mix, product mix, increasing the share of the premium products. I am not talking of any increase in the prices in the market. If that comes, that would be add-on there too. So it is basically through our better geo mix, as I mentioned, better product mix, and improving the shares of the premium product. And more importantly, in the coming year, we also, JK Lakshmi, as you would have seen, that we have already become a net debt-free company. And going forward, that will help us to improve our bottom line on an EPS basis or a PAT basis.
All right. You mentioned about premium sales as a percentage of sales. What is it? Where is it headed? Because you're talking about a large increase over there.
Yeah, our premium product sale is about close to 25% of the trade sales, and we expect it to be increasing to about 30% of the trade sales.
Okay, and trade sales itself is how much? It was relatively lower for y'all, but over the last 12 months or so, you have increasing that. So what is trade sales?
Yeah, we have increasing. Our target is to ultimately go up to about 65%. Last year, we clocked about 57%.
Right. You also spoke about renewable energy and that aiding your costs. Just wanted to understand how much of your cost savings would come about on account of the solar plant that you've added?
Solar plant, we have already added 7 megawatt, one in Sirohi. Another, as I mentioned, we have tied up for the private player under the captive mode about 40 megawatt of solar power in the Durg plant. So that should help us to increase our share of the renewable power. If you talk standalone Durg only, then it will be 80% plus. But overall for the company would be about 50% plus.
And the quantifiable cost benefit of that would be how much?
We expect that to be in the range of about 40 to 45 crores.
Right.
All right. Issa, if you could help us out with this, you just mentioned that you're debt free. I think you're referring to the standalone entity, right? That you're debt free.
Yeah, on a debt. Standalone.
Now, but you're still paying interest of say around 90 crores, but I think you must be having equivalent cash as well in the books. That's why you're saying that net debt free on standalone.
Yes, you're right. About 800 crores of debt, along with that 850 crores of the treasury corpus. So that is on a standalone basis, net debt free.
What about on the consolidated basis? Because Udaipur or there you're going to be putting on a lot of capex, which is lined up. So give us a few details. What is the current debt on a consolidated entity basis? And where is that number headed in the next 12 months or so?
We are on a consolidated basis. We are on a gross debt about 2,000 crores and on a net debt basis about 1,200 crores. The 1,200 crores is the debt which is sitting in the books of UCWL. UCWL is coming up in the next 1 or 2 months with a rights issue. So they are raising about 450 crores from the market. And that being rights issue, and with JK Lakshmi holding about 72% of the shares in UCWL, will be deploying that amount 72%. And would also be subscribing to any unsubscribed to a portion of the public in the event of there being any unsubscription portion left over by the public. And so that is what they are coming up. So next year, their debt equity will also be close to about 1:1 going forward. Next year, we expect the balance drawal of the loan also, about 500 crores of loan, which they still need to draw for completion of the expansion.
Mr. Bidkar, in the past you've said you intend to raise your capacity to 30 million tons by FY30. Just wanted to understand how much of that would be organic, how much of that would be inorganic. Would that be on account of some sort of corporate restructuring as well? What's your plan there?
Basically, we are, as of now, not talking of anything inorganic. All will come through the organic routes. And once this UCWL expansion gets completed, we'll be close to 18 million tons. From there, our journey to 30 is very clear. That balance 12 million 6 million will come through brownfield expansion, and the balance 6 through the greenfield expansion. There we have recently been allotted 2 mines, one in Rajasthan and another in Kutch. So we'll be doing greenfield plants there but before that, the brownfield expansion at Durg and UCWL would come in, which will take our capacity initially to 24 and then from 24 to 30 by FY2030.
Good speaking to you, Mr. Bidkar. I think, the market wanted something more this is a past quarter. But as you said, the vision is clear. Standalone basis, you'll be delivering mid to high teen growth with the EBITDA per ton headed towards the 1,000 rupee mark. Thanks so much for joining in and filling us in with all of those details.